Good day, fellow investors. Walgreens, a stock that you have been requesting for a while now. So Walgreens has been so requested because of the fact that it is down 78% over the last 8 years. Retailer, pharmaceuticals, so it should be a very stable business, but you can see the stock is nothing but stable. And now that it's going lower and lower, that the market capitalization is 70 billion and the dividend yield is getting close to 10%, now it is of a point of interest that one needs to look deeper into. And that is exactly what we're going to do. It is a pretty well-known stock, so I'll also show the tools that I use to research such a name. We'll go through the whole process, so I hope you enjoy it. I did an analysis, just touched on it when I did 10 stocks back in June 2022, and we also discussed Walgreens, and the conclusion there was that for a 10% return, depending on what dividend you want to expect in the future, that it was too expensive, that it should be much lower in the 30s. It was trading at 40 back then, and now we are far from 30, we are below 20. So, of course, when it comes to dividend yields, with interest rates going from 0 in June 2022 or something like that to the current 5%, this changes everything in that segment. Now, to research and discuss Walgreens, we're going to use Seeking Alpha. And I think if you click in my link in the description below, you have a discount. It lasts till the 6th of December, so you can check that one, the Black Friday late sale, by clicking in the link in the description below if you will be interested in also what you see, how I use Seeking Alpha, and you'll see that in a moment. So I went to Walgreens on Seeking Alpha. You can get all the data there, but what is interesting here is all the analysis that various people write. I haven't written in a while for Seeking Alpha, but okay, I do something else now. Nevertheless, you can see a lot of opinions: buy, hold, buy, sell, and I'm never going after these ratings. But what I do when I click on an article, I read it for the information. For example, if you read 4 or 5 of these articles on a certain company, you're pretty sure that you get all the information out there necessary for you to make your decision, to see how the risk and reward fits you. There is nothing more important than how the risk and reward fits you. And by reading all of this, you can see how it fits you. That's the key. Further, you have also all the financials, 10-year financials there on Seeking Alpha, and perhaps even something that I also use a lot are the earnings call transcripts. So instead of listening, you can then calmly, whenever you want, read, and we'll also go through that during this analysis. So check Seeking Alpha. If you are interested, let's go to our analysis. I have summarized a little bit things here. The first article that we're going to read is by the Dividend Sensei. He is saying it is a sell at these levels, so this was just a few days ago, and you should buy something else. And I have summarized it a little bit. What are the issues there? There is 8 billion in debt, with interest rates going higher, especially with the downgrade from the S&P rating agency. Then the interest rates and interest costs will go higher, thus that would lead into a dividend cut. There is a negative growth for the business forecasted for cash flows. Free cash flows are just 700 million, and there might be more legal costs. And then going forward on the article from the Dividend Sensei, you can read about why the S&P rating agency downgraded it to close to junk and maintain the negative outlook. Management changes, uncertainty of the healthcare strategy execution in the coming year, challenges in deleveraging its balance sheet and sustaining strong cash flow generation amid a spate of transformative acquisitions activity in recent years. Further, from the rating agency, results, of course, below expectations, cash flows 665 million, which is a material decrease from pandemic boom, of course. But then you also read and you know that there is an opioid settlement payments, that the company had an operating loss of 7 billion in this year because of these charges. That's a lot for a company making 700 million in cash flows. And when they discuss also the rating, this is very interesting. They could lower the rating of Walgreens if there are any execution issues on the plan, the core and new strategies that we will discuss in a moment. But they can also take a positive action if it significantly improves operating performance, profit and cash flows, and leverage declines materially below 4x on a sustained basis. And then on the dividend sensei, he is continuing to scratch his head as to why Walgreens exists when its rivals offer the same services with better convenience. So that's also something you see. It is about the quality of the business when it comes to investing. Another article from Daniel Jones, and he there takes a segment approach, first discussing US retail, pharmacy, international, and of course healthcare. Something that I really want to add here is Amazon entering the field with Amazon Pharmacy, and when you make a lot of money, like Walgreens did a few years ago, and we'll see about that in a moment, but when you make a lot of money, others that are in your, guess what, retail business, others want to take part of that cake. And with others coming in, and your prescriptions going down a little bit, well, just that a little bit changes everything in the profits, because you come for something, then you likely buy something else, which adds plus, plus, and plus. But if the trend is negative, like Dividend Sensei has said about 5%, then that is a big risk, especially if a big player is coming in, and that seems like the case. If we look at international, there is stagnation at best at Boots. For healthcare, they have this Village MD. They are projecting about 10 to 20% growth next, so not as good as it was now, but still a business there, but just 8 billion of sales on the 120 billion now. And the conclusion there is that there will be more litigation, but that still Walgreens is a soft buy on cheap valuations. Another article there, this is Rob. Why is he buying going into earnings? It is a little bit older there, but then you learn, okay, there is new management, what's going on there with the strategy, and of course, the risks are significant, and then you also know it's a high risk, high reward, contrarian play. Let's now look a little bit at the earnings call. But also there I seen this, so Walgreens to close a 5 billion pension deal, so they are trying to offload the pension issues that they have with Boots. This is normal with legacy companies in the UK, especially Europe, but also in the States. And 5 billion is again a lot for a company that has leverage issues. And then going through the conference call, okay, we have a new CEO, and he describes the company, what they are doing, what's the key role of the business there. 78% of Americans live within 5 miles of a Walgreens. And he sees the opportunity to improve the cost base of the business, so 1 billion of cost savings during the fiscal year. And that is their strategy to turn around the ship. And on those examples of those strategy, line by line, headquarter cost, etc., that is not really convincing, to be honest, if I read it. They are reducing their capital expenditures, and everyone is expected to be back in the office late November. On the cost savings, there was a question then, there is always a Q&A, always interesting to read. We are closing unprofitable locations and optimize store hours, and practically the same stories that whenever a business gets into trouble tries to solve. But in my personal opinion, when it comes to these cost savings, those are never enough, because something else comes out of the closet that eats up all the effort they have done. If they target 1 billion, they will make 500 million. One lawsuit will cost them a few billion. So it's not really material to the business, and they didn't say how are they going to compete the next 10 years, which is then an issue on a structural basis there. And you can read cash flows. They don't give guidance, but how are they going to get to better cash flows? They just expect that things will improve. And then very interesting also, you go to read the comments of these articles or the transcript to just get a feeling about what the market thinks. And the chairman is 82, his wife live in Monaco and own 147 million shares, which translates in about, what is that, a 6/7 of the dividend. New CEO says that they're going to work with employees, but Glassdoor is in the toilet, according to the comment. They're going to sell the stake in Amerisource Bergen, but then I checked that it is 16%, 1.5, 1.4 billion, so not that much, and closing unprofitable things because they will be closed without an explanation. So there is not really great conviction there. But let's look at the presentation of earnings and financials, and then I'll give you my opinion, not these other opinions that are very informative, however. So free cash flow, very bad, you can see, compared to what we're expecting, compared to what were the expectations, because if you have 1.6 billion in dividend payments, this isn't enough. The guidance is pretty vague. They say EPS okay, and then we're going to do great on the plans, and everything is going to be great, but that is just management talk. And then you look at the numbers and you see they grew, but they mostly grew through acquisitions, Boot Alliance, this, that, and left or right. Actually, the core business is declining. If I look at capital expenditures, they are now investing a lot in new things, making a lot of acquisitions, and spending the money that maybe it was better used somewhere else. And now this is the key here, which discusses a lot about the company. Because if you look above, repurchases of common stock, 2 billion, 3 billion, 8 billion, 13 billion, 17 billion, 18 billion, and then stop. And the core of the repurchases were made 2017, 2018, when the stock was trading at 80. So they have destroyed more than 15 billion in value like this because of their buybacks. Because buybacks are the best thing to do. And I'm always telling people, yes, short term, buybacks push stock price higher, everybody happy. But here you see the actual destruction force of buybacks. Then it was great. Now they would have needed those 15, 20 billion that went out of the window like that, because buying a stock at 80 isn't like buying a stock at 20. Because then they thought that we are making so much money, nobody will ever come as a competitor. Then Jeff Bezos see, look, these guys are spending 5 billion on buybacks a year. I want a part of that 5 billion. He's coming in, and now they are making no more money. And this is the destruction story of buybacks. And then the balance sheet, the goodwill, 28 billion, which is much higher than the 20 billion equity, more intangibles, assets, long-term debt, not that high. Given the talk, I assumed it would be higher, but 9 billion, a lot of capital leases for the stores, pension liabilities, and also there is a lot of minority interest there, 8 billion, so the equity is just 20 billion for shareholders. 20 billion, 28 billion intangibles, goodwill, very risky situation. And that also explains how, since they did those big buybacks at prices of around 80, it was all south as the cash flows retreated, as the competition came in. And then when it comes to investing, you ask yourself, what am I getting for 17 billion 700 million in cash flows doesn't get cut it on 17 billion, 1.7 million dividend payments, no cut stated, but logic rating would advise that there will be a cut. It is a business with thin margin, retail, high competition, increasing competition, difficult business. And what do I get as an investor? Yes, the stock can go from 20 to 30 plus the dividends if things are really good. But then again, and that is the question long-term investors ask themselves. Then again, what if I go from 20 to 40, I sell? Okay, but are you willing to take the risk from 20 to 10 if you don't sell? Now we're already talking about value here. Private funds will come in, active investors should come in next year. So there will be this 20, 15, 10, 12, up to 17. There should be increased volatility for traders if you want to play with it. But the key here is the high competition that I think is too much of a burden. It's retail, as Charlie Munger used to say, it's goddamn retail, which means that profits are made for a while, then everybody else wants a piece of it, and then it ends up ugly. This business has been destroyed with those buybacks. I hope you as a shareholder enjoy them in 2018 and 19. That's it. I hope I have given you a lot of information so that you can make your investment decisions. I prefer other things. You can check my research platform. I'll see you in the next video.